I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity Mates, episode 19, back again and excited as always. We're going to bring you another episode where we try and break down the world of investing for you to try and make it easy and accessible. As always, I'm here with my equity buddy, Ren. How are you going?
I'm very good, Bryce. Great to be with you for episode 19. Very excited about this one.
Yeah, it is a good one. We have been fortunate enough to do another interview following up from our successful Alan Kohler interview last weekend. I suggest having a listen to that if you haven't already. But this week we chatted with a fellow called Ted Richards. Very topical as we've got the AFL Grand Final coming up this weekend.
Yeah, or yesterday as you're listening to this podcast. Hopefully the Tigers won.
Well, Adelaide for me, but
interesting.
Do you want to give us a bit of a spiel about Ted Ren? Take it away.
Yeah, so for those of you who don't know, Teddy Richards he's a bit of a household name in the AFL supporting circles, but not one that many people would associate with investing. So Teddy was a footy player for the Essendon Bombers for a couple of years and then came up to Sydney and played for my beloved Sydney Swans, lost the grand final in 2006, but won the grand final in 2012, was the runner-up in the club's best and fairest, and was named in the All-Australian that year. So a banner year for Teddy in 2012. What's less known, though, is Ted also has a interest in finance. He's completed a Bachelor of Commerce and a Master's in Finance while being a professional footy player. Now retired, Teddy hosts his own investing podcast called The Richards Report, and he works for the automated investment management service Six Park. If you don't know what that is, we'll explain it in the interview. We're really excited to have Ted on to discuss his unique journey into the investing world and some of the things he's working on now. So without further ado, here's Teddy.
Up the Crows. So we'll get stuck into it. I guess you've been a very successful AFL player, and you started the Essendon and went to Swans, and you've won a flag and named All-Australian, finished second in club's best and fairest, and that's probably a side that a lot of people know you for. But the other side that not many would know, I assume the general public anyways, is your sort of commerce background. You've got a master's in finance. So let's just start at the beginning there. Tell us a bit about your background if you can, and what sort of got you interested initially in investing.
Well, I was never, as much as I love football, I don't feel like I was ever a player that saw myself as being someone that would have a 16-year career. So I always, once I was drafted at the age of 17, wanted to have something as a backup, just in case I got a tap on the shoulder at any stage throughout my career to say that my career was over. So I worked hard at football to make the most of the career that I could have there, but at the same time, by working in my studies or work outside of football, it meant that it kind of was reassuring to know that I was putting things in place if football didn't work out.
So how did you manage to balance football with your sort of interest in commerce, and was it easy, or is it something the club supported, or how did you sort of get around that?
The clubs do support it, and as much as I wish I could say that it was easy, it was hard work, and I guess it was trial and error, balancing football and study. And a lot of my friends who are in study had one strategy, which is common with most, is that you very much cram towards the end of your of the semester. Whereas, which is what most do. But for me, priority is my routine and being disciplined for football, which meant that my sleeping patterns and diet couldn't be put in jeopardy. So I had to try and be the model student that's engaged right from week one, and make sacrifices in other parts of my life to be able to, get the marks and pass the subjects that I did.
Yeah. So thinking back to some of those early days, aside from obviously having to be a professional footballer on top of learning about investing, what were some of the hard things you found about getting started, and what lessons did you take away that you sort of tell other people who are thinking about starting or just starting their investing journey?
A lot of people put emphasis on tertiary qualifications, but I think you can get fantastic insight and information from reading books and also listening to podcasts too. Yeah. But the book that hooked me was a classic, Peter Lynch, One Up on Wall Street. I think I read that about the age of 17 or 18, and that was what really got me excited at the possibilities of investing in the markets. But there's obviously many books written about and by Warren Buffett and Charlie Munger. Those two are fantastic. But one of my favourite books is probably Howard Marks' The Most Important Thing. I think people can get a great education from just reading those books.
Yeah, it's something that a few people that we've interviewed on the show have definitely said is the biggest way that they or anyone can improve their investing. And you mentioned, Charlie Munger and Warren Buffett. So is that your chosen sort of investing style or philosophy, and is that what you started out, and has it changed since? Or can you just give us a bit of a rundown on what your investing style is?
Yeah, so I guess my investing style has probably taken a bit of an evolution over since I was about 17. So I got drafted to the Essendon Football Club when I was 17, and when the paycheck started coming in, I started thinking about what I was going to do with my money, and somewhat naively, maybe a bit arrogantly, I thought I'd invest myself in the stock market, and I learned some pretty expensive lessons in that I was trying to chase speculative stocks about rumours that I'd heard in the change rooms, and I was probably without actually doing any of analysis myself, and I was doing things that people should do the opposite of. And so those are the early days, and I then did a bit more reading. And when I finished my Bachelor of Commerce, I worked for 2 years whilst I was still playing football at Citigroup in research sales. And when you're working along with brokers, it was very educational for me. But with brokers, I guess it's all about flow and stocks of the day. And so sometimes I'd get caught up in the hype of these stocks of the day without taking real long-term views. And I don't mean to speak down of my time at Citigroup. It was fantastic, but I think it wasn't until I did 4 years working under a fund manager who I think is Australia's best fund manager, John Sevior, a real value guy that is the opposite to someone that's going to get caught up in the hype of a speculative stock or a stock of the day, that is happy to be contrarian in his views and to buy when everyone else is selling. I think I did take a lot from my 4 years there, so I do have a big conservative value mindset to my strategy, but at the same time, working in the passive side now, I can see that I work in automated investment, and we invest passively. I think that serves a role for people that aren't in the markets every day and on top of each what company is doing. So I'm probably a bit of a fan of the passive side, but also maybe a bit of a hub and spoke where you can have a strategy for one area, and then maybe some stocks that you think you might have an advantage in but also investing in those too. It's a bit of a long answer, that.
No, it's good. It's good.
So, I mean, you've just touched on it there. You're now working on you're working for Six Park, and they do automated investment. They're an automated investment management service. Maybe for all our listeners out there, we'll start at the very beginning. Can you explain what an automated investment management service is?
Yeah, so we're just like a financial advisor in that we can give investment advice, but instead of being face to face and paying the fees and having the costs that are incurred there. We automate that process, and by doing that, it heavily reduces the fees that we charge our clients. So it's professional investment advice, and Six Park, that's the business I work for. Our investment advisory committee is made up of 4 gentlemen. 2 are our founders out of JP Morgan in New York. One is ex-JP Morgan of Australia, and he sat on the Future Fund of Australia. He got another member of the Future Fund involved, Paul Costello, and they've also got Lindsay Tanner involved, the ex-Minister of Finance for Australia. So those 4 gentlemen are the ones that choose, pick and choose the investments and oversee the investments, as opposed to me, the washed-up footballer.
Just to understand it, so are they out there picking stocks as, or like giving it, like creating like an overall strategy, or is it all sort of algorithm based and then they're like building the business?
So it is algorithm based. We are a robo advisor.
Okay.
So the way that it works is people answer questions online to get a risk assessment, and that risk assessment will go through our algorithm, and we'll then be able to give them an asset allocation specific to their risk assessment, which will be made up of 7 assets, each in different proportions to their risk profile, and they'll all be invested in the market and overseen by the 4 gentlemen I mentioned before, whose job it is. One of them described it as spotting the potholes along the way.
Okay. Just make sure the algorithm's not throwing up some real out of left field stocks.
Yeah. Well, and we do invest passively. So instead of when we get out, so instead of say for our when we invest in the Australian market, instead of us picking stocks there, we'll take the ASX 200.
Yeah. And
that's a passive investment. We think that it's equally important to look at fees, returns, but also fees. And by taking this approach, we're still getting great returns, but your fees are just a fraction of what they would normally be if you were seeing a financial advisor face to face. I should also add that Lindsay Tanner said this the other day, that as much as we do value the algorithms that we used, you still need the human oversight, because the example that he used is no one's invented an algorithm yet for Donald Trump. So, yeah, and I don't think anyone ever will. So, technology is great up to a certain extent.
Yeah.
Yes, sounds interesting. So, just for our listeners or those that are looking to, get started, can you just give us a bit of detail on the finer print? Like, is there a minimum that we may need to get involved, and can we add to it as we go in small amounts, or what's the sort of finer details of starting with Six Park?
Yeah, so the way we work, our minimum investment is $10,000. You'd go through the risk assessment online to get your asset allocation. If you're happy to proceed from that, we'd open up a cash management account with Macquarie and a trading account with Open Markets, which is all in your own name. You'd be invested in the market. We'd do all your trades for you, and your rebalancing when required. You can add to it when you want to, or draw funds down. And this is all included in the management fee, which is just 0.5%. So on $10,000, that's $50 a year, which is, if you're doing just one trade, you're probably up for $20. So
yeah, definitely.
If you're doing trades a couple of times a year for 7 different assets, the fees do add up, but we just keep it at that 0.5%.
Yeah, nice.
So it's funny that we are interviewing you. Our last episode was an interview with Alan Kohler, and he was railing against passive investments and ETFs.
Yes.
And is very pro active management because he thinks that you still are going to get better returns, and it's his argument basically boils down to you sort of get what you pay for when you're talking about fees. So how have you found that? Have you been sort of poaching clients from actively managed funds? Because of your lower fees, or have you seen people leave ETFs to go back to active management? What's the interplay between sort of the passive side of it and the active side of the industry?
It's a very good question, and I think that active management serves a purpose too. But the reality is the numbers speak for themselves, that most active professional fund managers underperform their market. And I know of an S&P study that was done in 2016 that looked at Australian active fund managers, and I'm talking professionals, that I think 70% underperform their benchmark. So if the professionals find it hard to outperform the market, I think most part-timers need to really question, are they getting returns consistently above the benchmark? If they are, they're in the minority, and well done. You're doing that. You're doing what most people can't. But I think for most people though, it's hard to consistently get those numbers, and that's why we believe that the passive investment and just getting the market returns is a good strategy.
Yeah, definitely. I think it's pretty hard to argue with the weight of evidence over recent years, and the amount of money flowing into the sector is pretty much testament to the returns that you can get.
And we also, if one of the greatest, arguably the greatest investor of all time, Warren Buffett, is, when he passes away, wants his money invested passively in index funds.
Yeah,
that's a big tick for our investment strategy too.
Yeah, definitely. So you talked about there were 7 asset classes that you will invest in. What asset classes won't you invest in? Is there anything that you don't touch at Six Park?
So our 4 growth assets are Australian equities, international equities. We've got international property, and the 4th is emerging markets. They're our 4 growth assets. Our 3 defensive assets are infrastructure, fixed interest or bonds, and cash. So we do cover a lot across that spectrum. We choose not to invest in gold. I think there's a lot of volatility there, and currently right now some of our investments are unhedged. We don't form opinions on currencies, which has worked against us, in the last month. But we're of the belief that we want to keep that unhedged.
Okay, and no sort of super exotic, Bitcoin ETFs or anything like that. Well,
personally, I don't. We don't invest in that. We love proven investments with a great track record, with liquidity, and but on a personal note, I do find it fascinating to read about the technology that is blockchain and how Bitcoin and Ethereum are utilizing that. And there's been some very valid arguments being put forward as to why this is something that is here to stay. But I'm happy to miss out on that if I miss the boat there.
Yeah, it's something a few of our mates have been getting involved in, but who knows what's going on. So, there's a lot of chat at the moment about valuation of markets, both domestically and internationally, and volatility of political situations, and obviously Bitcoin and that sort of stuff. So, I mean, I'm sure at Six Park there's been conversation about the sort of macro goings on of the world. Do you sort of have a view of where we're sitting at the moment and what might be coming down the track, and sort of how your portfolio's weighted for certain events to occur?
Yeah, so I sit in on the investment advisory committee, but I'm not actually a member of that committee. So, and I'm lucky to be able to absorb the information that these gentlemen speak about. So Brian Watson and Paul Costello, Lindsay Tanner, and Pat Garrett, they speak about very much macro themes and issues that they think are on their watch list. 3 months ago, they were of the opinion that interest rates around the world may start to creep up, which we haven't seen in Australia as of yet. But to mitigate that risk, they decided that they'd slightly lower all our clients' allocation to bonds, just on the odd chance that rates did start to increase in the foreseeable future. So that's something that we've seen at Six Park, that we're I guess trying to put things in place to, if it does happen. But apart from that, it's a dangerous game forecasting. It's a dangerous game forecasting tomorrow, let alone 6 to 12 months time.
Yeah, definitely. So I guess we should turn to the other big thing that you're doing at the moment, which is you're a fellow podcast host.
Yes.
So you host the Richards Report, which is also about finance. So what made you decide to start doing a podcast, and how's it going so far? And if our listeners are interested, where can they check it out?
Yeah, well, I guess it all originated with the fact that I was just some of the conversations that I was having with family and friends about what I do at work, and I was really surprised at how quickly I could lose someone in a conversation by what I thought was toning things down. And sometimes people don't want to ask a question about what an acronym stands for, because they don't want to be seen to be unaware of what it means. So I just wanted to kind of somewhat similar to what you guys are doing, have a podcast where I'd be asking what people might think of the dumb questions and breaking jargon down, not talking in acronyms, speaking with industry experts, about trying to get some insight without having to, I guess, commit to 400 pages of a book or pay a lot of money, and just start a process where someone can start to, I guess, get a bit of insight and form an opinion on how investment works.
Yeah, nice. So you spoke there about one of the aims, sort of to break down the jargon and that sort of stuff. Do you mind sort of shedding some light? Are there any sort of simplistic tick boxes that you may personally have outside of Six Park when it comes to deciding what to invest in, like maybe specifically specific companies, or is there anything that you look for within your style of investing that could be translatable to someone who's beginning?
I guess I by no means did I come up with this a strategy that is a fund manager that I worked for. But if I was to look at a company, I think there's 4 different ways you can, 4 important ways you could analyze the company. And I think a lot of risk when you're looking at individual companies is about the amount of debt that company's holding. So you want to first of all tick off the balance sheet and make sure that balance sheet's not holding too much debt. And so I'd look at net debt to EBIT and a few other measurements there to form a pass neutral or a fail on the balance sheet, and then from there move on to the quality of the business. That's quite subjective, where you've got to determine, is someone in a fantastic area, like, I don't know, are they, for example, Domino's Pizza's been a great recent example in Australia, where they're just making dirt cheap pizzas, whether you like them or not. And they're going around the world, and their recent reporting season wasn't great, but if we're looking over the last few years, that they have been a fantastic business. It's grown. And, so, or are they something like a Blockbuster Video, where you go, that's a fail. So quality of business, pass neutral or a fail. Move on to the quality of management, and this is also subjective, where you've got to have a look at someone's track record to form an opinion on the certainty as to what they, and the trustworthiness as to what you think is going to happen in the future. And that's, I'd probably give them a pass neutral or a fail. And then you move on to the valuation, which is probably the hardest of all, and where we're seeing probably a lot of companies tick the first 3 boxes, but a big cross right now in the valuation. And so this is by no means my little checklist. This is I learnt this from John Sevior, the fund manager that I worked under for quite a few years, and that's how I'd look at a business.
Yeah, right.
Yeah, nice one. So there's a lot there in terms of what you look at, and it requires a lot of information and a lot of research. What's your sort of go-to to for trusted information or for new investment ideas? Where's the sort of first place that you look?
Yeah, it's a good question that I don't think you should eliminate anything. I think, and Peter Lynch is he speaks about this as to be open to gaining insight from anywhere. And I love reading the AFR, the Fin Review, because there are some very smart journalists that write articles, but there's also the opinion that if you're reading something in the AFR about a company, it's probably too late. Mm-hmm. So an example of that is a company in Australia called Catapult that make GPS units, making GPS units around the world for athletes. I had one of those strapped to my back for about 5 years whilst I was playing football professionally. The company IPO'd. I looked into the business a bit more and decided that I wouldn't put any money in. I probably should have asked and done a bit more research, because it turns out it's been it's a real success story in Australia, and they're going around the world selling those GPS units to the NFL players, EPL players, and other soccer players around Europe.
You often hear about the successes of a lot of investors in the media, and with Bitcoin, a lot of people making lots of money, but you rarely hear about the losses that people make. I mean, I'm sure you've had some losses along the way. Is there anything that sort of sticks out, and what was one of the biggest learnings that you took from that?
Yeah, it's just early days, getting caught up in hype, probably born out of fear of not wanting to miss out, and stocks with, I guess, where if you would ask me about the balance sheet, quality of business, the management and the valuation, probably at the time I couldn't have told you that. I couldn't have answered those questions. So I guess getting caught up in the hype is an expensive lesson that I've learned a couple of times, and hopefully I've learnt those lessons. And I think another advantage of passive investment is that it removes behavioural bias and mistakes that we can make when you get caught up. I think a lot of people, say, for example, get anchored into a price as what's good value and what's bad value purely because of what they paid for it. And that's another reason why I like the passive investment strategy.
Yeah, nice. I can certainly relate, and I feel myself moving towards that sort of passive and buy and hold, set and forget, as Alec calls it, because can definitely relate to the get caught up in the hype and pay for it later on.
Yeah, definitely. So I guess going back to your podcast, you had Juddy on as a very early guest, which sets the bar high early for future guests, I guess.
It does, doesn't it? Yeah, it's probably going to go down from there.
Yeah.
So for people that aren't familiar, Chris Judd, famous Brownlee medalist in the AFL world, and Chris and I actually grew up together, and I was aware of, like me, Chris had a real interest in investing, and I wanted to just, I guess, give people some insight as to, one, that he's more than a footballer, and two, how deep his analysis goes.
It was
fascinating.
Yeah, I was blown away. I didn't realise he was so into investing.
So Chris has been able to earn a good income from football, and so he's got an amount of money that he manages himself right now, and I think he pretty much views that as a full-time job. He has an office that I think he goes to and does a fair bit of reading. He's got a few mentors that help him along the way, but he has a niche market of small cap stocks and micro small cap stocks that his universe of stocks is very limited to. He's not out there forming an opinion on ANZ Bank or Westpac or Wesfarmers over Woolworths. He's investing in companies that most of us have never heard of before, and I think he's having some success in it. Well, I hope he is.
Yeah. So I guess the natural question from that is there any other AFL players that, you know, are secret gun investors that you might be getting on the podcast in the future?
Well, you'll have to listeners will have to subscribe to the Richards Report.
What a
check me out on
setup.
iTunes.
Yeah, definitely.
And,
that should get some listeners.
Yeah, I try to keep the podcasts under 30 minutes because otherwise I think people are getting sick of my voice. But the interview with Chris was going so good that I think it went for about 50 minutes. So I split it up over 2 interviews because I think I couldn't contain it just to 25 or 30 minutes.
Yeah. About sports people and financial literacy more generally, it's something that really fascinates me because, you know, in America, the statistics are you know, horrible. I think it's something like 80% of NFL players go broke within 2 years of retirement, and it's something like 60% of NBA players go broke within 5 years of retirement. Do you reckon we do it better here in Australia? And, you know, footy players and other sportsmen and men and women are set up to sort of set up their financial future from their playing days?
Well, I think we do, and it is hugely concerning. I've heard those numbers before, to think of young people that are given huge sums of money at the start of their, you know, when they're only in their early 20s, and to think that they could be set up for life, and it has the opposite effect on the quality of life for the rest of and that they file for bankruptcy only a couple of years out of retirement. So I do think we do it better in Australia. I'm not sure why. I think financial literacy plays a part, and budgeting, but I think it's a lot of the factors comes down to maturity and people not getting ahead of themselves.
Yeah, that's really interesting. Well, hopefully, you know, a lot of players out there can listen to the Richards Report and Equity Mates and, you know, learn a thing or two from them. And
Yep.
Yeah. So I guess we'll start to wrap up. The big question that I guess we both have to ask you is the grand finals coming up this weekend. And, you know, we'd be remiss if we didn't get your thoughts on it. And, you know, if you want to put yourself out there, do you have a tip for the game?
You know, I haven't given you a stock tip or anything like that, so I may as well give you a call on this game. And I've got to be careful because some people are going to be listening to this in weeks or months from now and go,
True.
That Richards was way off. I was surprised that Trent Cotchin got let off this week. So I think.
Oh really? Wow.
Yeah, I want him to play, but I did think that I was probably leaning towards the fact that he was looking at a suspension, because I just thought that's what the AFL was going to. And so when that happened, I thought, well, the footy gods are shining. Looking down on Richmond, and I think it'll continue. I'm caught up on the Tigers bandwagon. I'm living in Melbourne these days, and it's just to see a club that's been so deprived of success for so long be in this opportunity. It is exciting, but equally, I do feel for the Adelaide Crows, because that club has been through a lot for different reasons, both for the players and coaches. And I think it would be a great story if the Crows did win, and it would be good for football too. But I think the Tigers to continue on, and Dusty Martin having Lee Matthews called it the best season ever by an individual player. I think you're a fool if you take a contrarian view on Dustin Martin right now. So I see that to continue.
Yeah.
Is he going to go the big three, the Brownlow, the Premiership, and the Norm Smith? We'll see.
Yeah. Well, you know, the form line says that he will continue, and hopefully this all the events of this week and the media commitments from winning the Brownlow isn't going to take a toll on him.
Yeah, true. Oh, I mean, Melbourne has a public holiday for grand final weekend on the Friday, and I think if Richmond win, you're going to have a public holiday on the Monday because Melbourne's going to go into meltdown.
Yeah, and
It's just going to go nuts.
yeah. On a side note, I think the public holiday should be on the Monday anyway, not the Friday. I think most people just take the day off on Friday anyway.
Yeah.
Well, look, we'll wrap up, Ted, and really appreciate your time coming on. We always like to finish with 2 questions. You've sort of answered them earlier in the podcast, but just to sort of refresh, or if anything else you'd like to add. The first is there any must-read book that you would recommend, financial or otherwise, it doesn't matter, that it would be great for a beginner or that you've really found beneficial throughout your sort of process? And then secondly, more generally, any pieces of advice that you'd like to sort of give to those that are looking at really just getting started in investing?
I guess to answer the first question is read. I think Buffett comes out and said it's got a quote, something like read as much as you can, and the younger you start, the better. And so books are fantastic, whether it is Peter Lynch or Howard Marks, Buffett, or there's also I can remember reading a great book, Bull's Bear and a Croupier. I think Kidman might have written that, and that's an Australian fund manager that wrote that book. Hedgehogging's another good book, but I think buying a subscription to the AFR and getting into a daily habit of reading that is it's fantastic advice. What was the second part to the question?
The second was, if just some general, do you have any sort of general advice for those that are looking at getting started in investing?
Yeah, I guess the advice would be don't put all your eggs in one basket. Understand your circle of competence, in that if you do go down the active path and you want to start stock picking, be aware that there's someone on the other side of that every trade, and it does come with a certain level of commitment that you need to stay on top of these. There's not too many stocks that I think are set and forgets with the way the world's moving, and I guess that would be the advice. Just be conservative and don't just jump straight in the deep end.
Yeah, nice. Some great pieces of advice and some great books there. So yeah, look, Ted, really appreciate your time coming on and sharing that with us and telling us a bit about Six Park, something that I'm certainly going to have a look at. And as we mentioned, you've got the Richards report as well. So for any of our listeners that want to get another take on investing, definitely jump on and have a listen to that. So yeah, a big thanks from us, and we'll probably look forward to hopefully having another one further on down the track maybe.
Yeah, absolute pleasure, guys.
Equity Mates and the people appearing in this program may have positions in the companies mentioned. This is general advice only. Please speak to a financial professional to understand how it may pertain to your individual situation.